Hello, I'm Ben Jones and you're watching Dukascopy TV. It's the final day of the trading week, so joining me for the weekly wrap-up is Alex Smith from First National Bank. To begin with, Alex, I'd like to discuss the South African inflation rate that was released. It dropped from 6.4% to 5.9%. Was this expected?
Yeah, I'd say the drop was expected, but perhaps not by such a large magnitude. We had forecast 6%. I think the market average was about 6.1 or 6.2, so the larger than expected moderation. And it was driven largely by lower food and transportation costs. In particular, there was a steep petrol price cut during September, which added to the inflation decline. Going forward, we do expect inflation to moderate further over the coming months, and that should allow the South African Reserve Bank to keep interest rates on hold for the remainder of the year.
Now, Eurozone PMI data was also released this week. Did anything surprise you with these figures, and what do they show for the euro area?
Yes, look, the headline numbers appeared to be relatively good with a slight rebound in the composite PMI, but I was a little bit surprised by some of the underlying data, which kind of indicates that growth seems to be slowing further. In particular, the fact that output charges or charges for services and manufacturing combined actually fell during the month. And at the same time, input costs rose, so there's significant margin pressure underway, and this against the backdrop of relatively weak demand is resulting in rising levels of job cuts. So, firms having to cut jobs means that the overall outlook for the economy is perhaps deteriorating a little bit. This sort of higher frequency data is usually the best indicator of the most recent activity numbers. So it is a little bit concerning, and it does lead me to believe that the ECB will have to do even more stimulus to keep the economy going.
And finally, the UK has had a busy week. Firstly, 2 votes from the MPC went in favour of a rate hike, and then GDP figures were released today, dropping slightly from 3.2% to 3%. How will these both affect the UK?
Yes, okay. So I think that the first thing to bear in mind is that even though GDP growth in the UK is pretty robust at this stage, the economy is still only about 3.5% larger than at its pre-crisis peak. So there's still quite a lot of slack that exists in the economy. And if you look at some of the sectors, you can see that within agriculture, production and consumption, these sectors are between 8 and 10% below their pre-crisis highs. So there's still a lot of slack in the economy, and I think this ties in with what the Bank of England has been saying and been seeing recently, in that inflation has actually been extremely low, and wage growth has actually been extremely low in the UK, and that also points to slack in the labour market. So the combination of slack both in the real economy and the labour market, and the fact that commodity prices globally are coming off, there's a lot of weakness in the European economy, and the pound is relatively strong, means that I don't think there's any need to raise interest rates too quickly in the UK at this stage. So the minutes that came out earlier this week sort of point to the fact that some policymakers are perhaps becoming a bit more circumspect about the timing of the first rate hike, and are perhaps pushing it out a little bit. Certainly the market has pushed out the timing to the second half of next year.
Alex, thank you very much for joining us on the line today. That's all we have time for now. Thanks for watching, and click back next week for plenty more updates and exclusive interviews. Goodbye.